Welcome, everybody. I'm Emily with the Georgia Center for Nonprofits, and you are here today for our first community event of the new year, the Nonprofit Insurance Crisis, what you need to know and what you can do. And we are really thrilled today to have Joy Bernhard, who is with the Nonprofits Insurance Alliance, who's been a great partner to GCN for a while now, and is going to share some really excellent information for us as we kick off this new year. So with that, officially, Julie, welcome. Thank you.
Yay, thank you so much, Emily. Thank you for having me today. So we appreciate you joining us today. As Emily mentioned, I'm Julie Bernhard and with Nonprofits Insurance Alliance. CW was supposed to be here today, but he's unable to join us. Something to know is that we only work through brokers. So CW is one of the brokers that we work with. And so I'm sorry that we're not going to be having any broker representation, but I'm going to do my best to cover items both from a broker's perspective and from a carrier's perspective. Because we don't work directly with the nonprofits we serve, it's brokers like CW that help us to serve the nonprofit sector. So let's get started. Right now, nonprofits are struggling to find and maintain affordable commercial insurance coverage. So this presentation will go through all of the conditions that are making it difficult for organizations like yours to get affordable insurance or to even purchase certain coverages. But knowledge is power. So we're also going to be explaining how to position your organization for the best possible renewal outcome, risk management best practices you should abide by, and what alternatives are available in the commercial marketplace. So to start off, let's walk through some of the market conditions that have led to the current insurance crisis that's facing nonprofit organizations today. So one thing to keep in mind about the insurance industry is that it's cyclical. What goes up must come down. But in the insurance universe, what comes down must also go up, unfortunately. So right now, we are in the middle of a very hard market with no end in sight. During soft markets, premium rates fall as insurance carriers compete to increase market share. In a soft market cycle, carriers are more willing to offer broader coverage and to relax underwriting standards. However, lower rates for more expansive coverage eventually takes a toll and insurer profitability suffers. When the pain becomes too great, carriers begin tightening underwriting appetite and demanding higher premiums. This chart shows the last 3 hard market cycles in the US. So while rate levels fluctuated somewhat over the past decade, the overall trend has been softening rates since 2004. Some industry experts believe that we avoided what likely would have been the last industry-wide hard market cycle in 2008 with the too big to fail bailouts. Most industry analysts agree that this hardening of the market is long overdue. The following are key takeaways from the Council of Insurance Agents and Brokers Commercial Property and Casualty Q3 Market Report. So it's important to note that this is an insurance industry-wide report, including all sectors of business. The nonprofit sector has been one of the hardest hit, while other industries, not as much. The market continued to harden in Q3 2020, with premiums increasing by an average of 11.7% across all size accounts. And this marks the 12th consecutive quarter of increased premium pricing across all size of accounts. In Q3, The umbrella line was one of the most troubled lines of business. Umbrella and directors and officers premiums increased by far the most in Q3 2020 at 22.9% and 16.1% respectively. There were many influential factors that were driving this increase in umbrella and D&O pricing. We're going to be getting into these driving factors in the next section. But first, let's talk about capacity. So capacity is the largest amount of insurance or reinsurance available from a company or the market in general. The significant price increases for umbrella, commercial property, and D&O were accompanied by equally significant decreases in capacity. And this capacity contraction came with increased deductibles, lower limits, and reduced coverages. So when you think about capacity and the relationship between capacity and rate, what we're essentially talking about is supply and demand. Again, since this is an industry-wide report, absent from the chart are coverages like professional liability and abuse coverages, which aren't applicable to all sectors of business. However, these lines also saw significant decreases in capacity, along with the corresponding rate increases. So in summary, the nonprofit insurance marketplace has been showing signs of distress for years. It's now colliding with an industry-wide hardening of the insurance market. This translates to strict underwriting, increasing premiums, and a reduction in capacity. So now that we understand what the market conditions are, let's take a look at some of the factors that are driving those market conditions. So we've all seen it, more and more reports in the news shining a light on cases of sexual abuse of children. Boy Scouts of America was in the news quite a bit last year. The number of sexual abuse claims against this bankrupt nonprofit rose to over 90,000. As a reminder, last year, the Boy Scouts of America filed for bankruptcy after facing hundreds of lawsuits from people who say that they were sexually abused as scouts as far back as the 1940s. A lawyer representing some of the victims reportedly said he had never contemplated the number would be so high. Claims have been filed in all 50 states and even abroad. The Boy Scouts of America is looking to set up a victims' compensation fund as part of its bankruptcy filing, and said it was devastated by the number of lives impacted by past abuse. So for nonprofit organizations like yours, increased public awareness is one of the driving factors in the current market conditions. When providing educational, recreational, or other services in your communities, many of your organizations work with children, teens, the elderly, and disabled populations. And you should consider some type of abuse molestation coverage. But thanks to current market factors, what we're seeing right now is that the commercial insurance market is generally backing away from offering coverages for certain exposures in organizations, like abuse molestation coverage. And when it is available, it's often for a high premium and low limits. There's no denying that the landscape has changed for the risk of sexual abuse. But what is important to note is that we're not seeing an increase in the frequency of sexual abuse claims, but the cost of resolving these claims has increased over time. And why is that? Well, one of the reasons has to do with statute reform. In state after state, lawmakers are now reconsidering laws that barred victims from suing. Over the past couple of years, 23 states and DC had new laws giving childhood sexual abuse victims decades more time to file civil lawsuits. And 36 states saw statute of limitation reform bills introduced. So this is opening up the possibility of new lawsuits for abuses that occurred decades ago. In today's climate, organizations and their insurers may be responsible for potentially huge new claims that they may not be prepared to cover. Insurers' actuaries will need to think about how they will be accounting for the financial consequences resulting from this legislation. So this retroactive liability, which is occurring without having collected the premiums to pay on the claims, is really a recipe in the insurance world for fiscal instability. And when we're talking about abuse and molestation coverage, it's important to note that it's not been around that long. Back in the 1980s, it didn't even have its own separate policy form. So unless it was specifically excluded, then it would be assumed to be covered. Any organization that provides services to youth, developmentally disabled individuals of any age, or senior citizens should consider this type of insurance. The intent of this coverage is to respond to allegations of sexual abuse. This is not to be confused with sexual harassment, which is more appropriately insured under a directors and officers policy. Some insurers claim that this coverage is included in their general liability insurance because the policy doesn't specifically exclude improper sexual conduct. But relying on a general liability policy is a risk that may provide no coverage for employees and volunteers who may be unfairly accused. So unless this coverage is purchased as a separate policy, specifically providing coverage for improper sexual conduct, you will likely not have any coverage for your innocent employees or volunteers. So another driving factor in today's marketplace is social inflation. And so when we're talking about social inflation, we're talking about the rising costs of insurance claims that are the result of societal trends and views towards money, corporate America, and litigation, which is resulting in broader contract interpretations, plaintiff-friendly legal decisions, and larger jury awards. So in a nutshell, the perceived diminished value of money plus public perception is equaling big payouts. An article in Insurance Business Magazine stated that one of the biggest drivers of social inflation is a general anti-corporate sentiment and a feeling that someone has to pay when some kind of damage or injury is sustained, regardless of negligence. So 2 takeaways from this article. One is that nonprofits are no longer immune to anti-corporate sentiment as they once were. And 2, in the American system of tort law, when someone is harmed through negligent behavior, and the key word being negligent, the objective is to make that person whole again through monetary compensation. Negligence has always been the trigger for liability, but today it's about remedy, which begs the question, how can you even defend your organization against a lawsuit if it doesn't matter that you didn't do anything wrong? So in addition to social inflation, litigation financing is another buzzword in practice that has been gaining momentum in recent years. Litigation financing is the practice where a third party, unrelated to the lawsuit, provides capital to help plaintiffs litigate cases they might otherwise not afford in return for a portion of any financial recovery from the lawsuit. So you may be asking yourself, well, why does this matter? Lawsuits are expensive. In the past, attorney fees would be a significant factor in a plaintiff's decision or the attorney's recommendation of whether or not to pursue a case to trial. Litigation financing removes that financial burden and more cases are going to court. Not only are more cases going to court, but their efforts are being funded and there is an expectation to win and see return on the initial investment. Since 2012, third-party litigation funding has become increasingly widespread. On the next slide, we're going to talk about nuclear verdicts. So both litigation financing and nuclear verdicts have been trending up over the same period of time. And if you're thinking this is probably not just a coincidence, you're likely correct. Although we can't know for certain, as most courts have ruled that litigation financing is not discoverable. Nuclear verdicts are judgments in excess of $10 million. Nuclear verdicts have been a consistently increasing theme in trucking over the past several years, and the pressure on carriers from rising insurance premiums appears to have no end in sight. As the trucking and insurance industries absorb nuclear verdicts, insurance premiums necessarily increase to offset the payment of claims. And then transportation costs then rise as carriers raise their rates to cover higher insurance premiums. And this is despite the fact that the number of deaths and injuries from accidents involving large trucks has been declining. Rising insurance premiums and nuclear verdicts are often cited in carrier bankruptcies as the primary causes for shutting down. In addition, the growing trend of juries awarding nuclear verdicts have forced some insurance providers to exit the insurance industry altogether. So the more accidents there are, the greater the increases in vehicle insurance premiums. One of the major issues contributing to this increase is distracted driving. The use of vehicles at nonprofit organizations vary with the services that your organization provides. Some vehicles take children to after school or sports activities. Some transport seniors or people with disabilities. And some deliver food, meals, or in-home assistance. Distracted driving is any activity that's going to divert attention from the task of safe driving. One of the things that we provide as a carrier is a distraction-free driving policy. Our members review this with their drivers, have them sign it, and add it to their employee file. It's just another way to help communicate to your drivers the consequences of distracted driving. And as extreme weather events continue to intensify, insurance premiums are going to keep rising as well. Hurricanes, wildfires, and other catastrophes in 2017 and 2018, they cost the global insurance industry more than $200 billion. The risk from wildfires, flooding, storms, or hail is increasing, and for many carriers, their only sustainable option is to adjust their risk prices accordingly. This is another factor that has led to this hard market and that is impacting nonprofit organizations. During 2018, NIAC, our California company, experienced the largest claim in its over 30-year history with the devastating Camp and Woolsey fires. While our team went into overdrive to get money and assistance to our members, especially those dealing with the devastation in the town of Paradise, we were humbled by the heroic efforts of the executives who worked tirelessly to protect their clients, even when they themselves had lost their homes and everything that they owned. The ultimate payout from these fires to our members was about $25 million. And because of excellent reinsurance partners, the ultimate cost to us was about $2 million. But for carriers who don't have appropriate reinsurance in place, a catastrophic weather event just like that could have put them out of business. So in summary, we just covered the primary factors that are driving these hard market conditions and making it difficult for many nonprofits to secure affordable coverages. With no end in sight, a lot of nonprofits are concerned about what they can do to position their organization for the best possible renewal outcome. There are some steps that you can take to make your upcoming renewal as smooth as possible. And as we've discussed in this market, we essentially have a supply versus demand issue. Many of the insurance brokers that I work with typically recommend that their clients shop their insurance every 3 to 5 years unless they have good reason to otherwise. This is because brokers want carriers to be excited about your account when it's sent to them. Brokers want the carriers to know that this is a real opportunity and that their work and efforts won't be in vain or just utilized to drive down the incumbent carrier's pricing or block markets to protect a broker from competition, which happens. Think about the current market conditions and how that is driving more and more organizations to shop their insurance right now. The sheer volume of submissions carriers are receiving is substantial. Two of the most elementary things your organization can do to position your agency for the best possible renewal outcome is to start early, a minimum of 120 days out, and provide all requested information in a timely manner. If you fail to start early and provide the time and information a carrier needs to get comfortable with your organization, knowing submission volume to these carriers is up and that you're vying with peer organizations to secure coverage from a much smaller pool of available limits, can you see how this is not in your agency's best interests? Starting early and providing all the requested information in a timely manner is critical in this market. And let's talk about broker selection. There's a really great article on the strategiccfo.com about choosing a broker. If you want to type your name in the chat box now or tell the facilitators later after we're done, I can send you the link. So the article explains the traditional approach to insurance like this. You identify 3 or more brokers who want to bid. Each broker will want to be assigned certain carriers, but then they're all going to want the same ones. You're then asked to answer an incredible number of questions that come in from the various carrier underwriters. You'll be answering the same questions multiple times to multiple brokers. Each broker will make a presentation, and by the way, they're all going to want to present last. And if each broker is successful in obtaining a quote for you, then you're faced with the impossible task of spreadsheeting each bid to make sure that they're apples to apples. You then have to go back to each broker to get specific questions answered so your apples to apples comparison will work, and so on and so on. I know this probably sounds all too familiar to most of you. So what if I told you there was a better way? In addition to being confusing, labor intensive and time consuming for you, dividing the very limited number of insurance carriers writing insurance in this sector amongst multiple brokers does little to drive competition. Another strategy to position your agency for the best possible renewal outcome is to unbundle the broker carrier decision by selecting your broker first and letting that broker approach the market for you. This is the way most Fortune 500 companies have been shopping their insurance for years. From my experience, working with multiple brokers makes no sense and doesn't benefit the nonprofit at all. For nonprofit organizations like yours, the most common way to secure insurance for your organization is by working through brokers. Brokers are also referred to as independent agents, and they're licensed independent insurance professionals. Insurance for nonprofits is a very specialized niche of the marketplace, and brokers working with these organizations must be able to assist them in understanding and evaluating the specialty coverages they require. An important role for your broker is to understand your organization's operations and to be able to advocate to insurance carriers on behalf of your organization. Another key responsibility of your insurance broker is to obtain quotes for insurance for your organization and to help you determine appropriate amounts of coverage. The broker you work with should be knowledgeable about commercial lines insurance and the insurance carriers that offer it. They should also be experienced with regard to the special risks facing health and human service organizations and the insurance products best suited to finance those risks. Insurance is not just important for your nonprofit, it's necessary. Having a strong insurance and risk management plan in place is essential to prepare for the unexpected. Without proper protection, misfortunes such as embezzlement, a lawsuit, or a natural disaster could severely damage a thriving nonprofit. And that's where the Georgia Center for Nonprofits comes in. They can assist with nearly every nonprofit risk, and their insurance and risk management consultants are glad to provide a complimentary analysis for your organization, as well as shop numerous insurance companies to find the best fit to meet your policy and budgetary needs. As a nonprofit, risk management should definitely be a consideration when choosing your broker and your insurance carrier. So the value of your insurance should include risk management and loss control resources. Your broker should assist your organization with loss control and risk management and be willing to take the time to learn about your agency's operations and provide thoughtful advice and counsel about your agency's exposures and insurance needs. Your insurance carrier should also provide services, training, and consulting assistance to help you prevent claims and mitigate exposures that are disruptive to the critical services that your organization provides. Risk management is a culture that should start with your broker and your insurance carrier and then continue throughout your organization. Speaking of risk management, let's take a look at some risk management best practices that organizations can easily adopt and follow. So these bullets are all different areas that we're going to briefly touch on for best practices to follow. We believe that risk management is a cornerstone of accountability in any organization. Programs such as volunteer management, safety procedures, and staff training help your organization to avoid injury, and you should be able to find most of these free of charge through your carrier. CW and I both work with nonprofit organizations, and we know how important safety is. And that includes your safety, the safety of your staff, of your volunteers, and those you serve in the community. Having written policies and procedures is important for several reasons. They communicate a culture of zero tolerance. They identify acceptable and unacceptable behaviors, and they define what abuse is and its boundaries. It's also important to note that policies and procedures should communicate the why behind the policies. They should include reporting procedures, and they should be reviewed and updated regularly. Policies really define the bandwidth of acceptable behavior. As a carrier, Nonprofits Insurance Alliance has a forms and templates library available on our member portal. So it's filled with things like checklists, forms, templates, policies and procedures, and waivers in a variety of topic areas. They're downloadable forms that can be customized to meet the specific needs of your organization, and they were created by our risk department. So if you need help creating a policy or procedure, you should check with your own insurance carrier for a template you can use. And when we're thinking about screening and selection, it's important to note that effective, thorough screening is the first line of defense. It sends a message that you take abuse seriously. Employment and volunteer screenings for positions of trust are highly recommended to reduce risk, provide security, and safeguard your mission. Your carrier should be able to put you in touch with a service for discounted background checks and drug screenings. And your carrier will also likely have additional resources for you, like this book advice on recruitment, screening, and selection. Keeping safety and risk management top of mind requires an all hands on deck approach. And this includes your consumers and their family members and or guardians. They should be taught to recognize boundary violations in an age appropriate manner, of course. It also gives you the opportunity to set expectations. So for example, if a family is moving an elderly loved one into assisted living or skilled care, and that loved one has been falling at home, moving them into care does not eliminate the risk for falls. So we need to make sure consumers and their families don't have unrealistic expectations. Setting expectations, transparency, and regular communication with consumers and their families or guardians has been shown to reduce both frequency and severity of loss. Conversely, a lack of communication can drive claims. Communicating these things lets consumers and their families know that your organization is focused on safety and is your utmost goal to provide a safe environment. How an organization responds to suspicious or inappropriate interactions, policy violations, incidents, or allegations of abuse can dramatically affect the outcome. Once a concern has been raised or an allegation made, swift, determined action must be taken to reduce any subsequent risk. And the action must be consistent. Organizations need to establish and adhere to a precise, unwavering incident response and reporting plan. And this plan should give guidance on interrupting the behavior, protecting the alleged victim from further abuse, gathering information about the alleged incident, documentation, reporting the incident to the proper authorities based on mandatory reporting requirements, suspension of any accused staff until completion of any investigation, or in the case of consumer to consumer abuse, appropriate disciplinary action up to and including when an individual is not allowed to return to the program. And this includes follow-up. It should address both staff to consumer abuse and consumer to consumer abuse. Lastly, for any risk management program to be successful, there has to be accountability and buy-in. The development of written policies and procedures is essential. But if these policy and procedures are only words on paper, then no one's going to hold them accountable. And how will your organization hold individuals accountable to the safety risk management policy and procedures that have been crafted? Well, accountability is often equated with punishment, but it doesn't need to be. We can also take advantage of opportunities to promote success as a positive approach towards accountability. And as I mentioned in a prior slide, safety and risk management is an all hands on deck matter. Similar to including your consumers and their guardians in the process, creating a culture of risk management includes the buy-in of leadership and your board. So now that you know about factors driving these hard market conditions, how to position your agency for the best possible renewal outcome, and risk management best practices, you should also know that there are alternatives in the standard insurance marketplace. So the insurance marketplace has evolved significantly over the past several decades. Organizations today have access to many forms of risk transfer beyond the purchase of traditional insurance. Risk retention groups, or RRGs, are a crucial and highly successful form of insurance for many business entities. RRGs pool their similar risk exposures to collectively self-insure. They're effectively owned by their members. RRGs provide an innovative solution for similar entities to insure themselves. We have seen RRGs formed for groups of hospitals, attorneys, financial institutions, and yes, even nonprofits. In 2018, there were over 200 RRGs representing total gross premium of $3.3 billion. RRGs also have a great deal of financial stability and remain committed to maintaining adequate capital to handle losses. There's a ton of benefits of working with an RRG. RRGs can develop highly specialized underwriting and claims handling because they're only focusing on one type of business. This is why they're so innovative and successful in the marketplace, and they are increasingly important to the way businesses protect themselves. But it's also important to keep in mind that all RRGs are subject to state requirements for minimum capital and surplus. So they're uniformly regulated in the same way as traditional insurance companies. But because of their specialization in only one field, they tend to be very competitive and innovative in the insurance marketplace. So Nonprofits Insurance Alliance, NIA, is an example of a risk retention group. NIA is a group of 501c3 nonprofit insurers whose sole purpose is to serve other 501c3 nonprofits by providing a stable source of reasonably priced liability and property insurance coverage. So NIA began as a direct result of the liability insurance crisis in the mid-1980s, when insurance companies were refusing to offer affordable liability insurance to nonprofits, believing them to be high risk. That was over 30 years ago. And through our financial strength, comprehensive benefits for members, and partnerships, NIA continues to ensure that nonprofits have their own insurance carrier that operates so members can continue their important services. We work through independent insurance agencies who specialize in helping nonprofits. So if you want a quote, all you need to do is ask your broker. And if you need a referral to a broker, just complete our online Get a Quote form. The insurance crisis we're facing right now has hit nonprofit organizations like yours disproportionately compared to other business sectors. But like we discussed, there are still things that you can do. When your renewal comes up, we talked about positioning your agency for the best possible renewal outcome. We also discussed some risk management best practices that your organization can follow. NIA is working hard to make sure that nonprofits have affordable and reliable options for insurance long into the future. To do that, we need Congress to allow risk retention groups like NIA to write property insurance for our members, as well as the liability insurance we already provide. HR 4523 is the Nonprofit Property Protection Act. And it's a bill that was introduced to Congress to help us do just that. Since all politics is local, members of Congress need to hear from you. Please tell your member of Congress to support this bill. But most importantly, I really do believe that it all starts with your broker. Providing service to nonprofit organizations is a very specific niche of the marketplace. And it's not something that all brokers handle. If your insurance gets canceled or your premiums double or triple at renewal, Your broker should know what other markets to shop around for your coverage for your organization. We're just one carrier. There are many carriers out there, and this is where your broker comes into play. If they don't know where to shop insurance for you, it means that you might not be working with the right broker because they can't access the markets that could still help your organization. The assistance is absolutely out there. You just need to be talking to the right people. I want to thank Emily and your whole membership group for taking the time with me today to learn more about what's happening in the insurance marketplace. And I hope this information will empower you in your future insurance decisions. Thank you.
Thank you so much, Julie. That was quite the roadmap you have laid out for us in terms of all the, of course, different factors and different routes we can take to mitigate both risk and also make sure that our insurance needs are covered, right? So we do have a couple of questions coming in. Reminder to everybody, submit those here in the chat and we will get those to Julie. And we'll also share, as you can see, CW's information as well as Julie's on the screen here. Feel free to reach out to them directly if you have an agency specific question. I know that both of them will very quickly get back to you. So our first question here is from Emily, and she says, can any insurance broker get quotes from NIA?
Yes, any broker can. If they don't have a current appointment with us, all they need to do is contact us and we will help them get appointed.
Excellent. All right. And then when we work through a broker like CW, Rob wants to know, do they get quotes from the RRG in addition to more traditional insurance companies?
They should, yes. So brokers who specialize in working with nonprofits are familiar with the marketplace. So they know what carriers provide coverage to 501c3 nonprofits. We've been doing this for 30 years. So they should be familiar not only with the traditional marketplace, but other carriers like us who have weathered the hard market a lot better than some of the traditional carriers.
All right, that makes pretty good sense. So I don't see any other questions coming in. So we will just remind everybody that, again, you can reach out to Julie or CW, who's our broker for GCN directly. Their info's on the screen and we'll follow up with you as well. Big thank you, Julie. This was truly just excellent information. Like I said before, a great roadmap. And so thank you to the Nonprofits Insurance Alliance, excellent partners in the industry and all working to make this world a better place, right? And especially with that advocacy bit that you mentioned at the end with the upcoming House resolution. All right, folks, that's it for us today. Thank you. We'll see you next time.
Thank you, Emily.
Bye-bye.